All right, let's dive into one of the most fundamental and honestly misunderstood concepts in our entire economy. Where does money actually come from? Now, it sounds like a simple question, right? But the answer, well, it's probably not what you think.
So when I ask that question, where does money come from, what's the first thing that pops into your head? For most of us, it's a very specific image, one we've all seen 1,000 times in movies or on the news.
Yeah, you're probably picturing these giant industrial printing presses, just churning out huge sheets of brand new dollar bills, right? Stacks and stacks of fresh cash. But here's the fundamental structural issue with that image.
In the entire US economy, all that physical cash, the actual bills and coins you can hold in your hand, that only makes up about 3% of the total money supply. Some estimates go up to 10%, but still, that's it, a tiny fraction. So if physical cash is only a tiny piece of the pie, where does the other 90+% come from? Well, most people don't realize this, but the vast majority of our money isn't printed at all. It's created digitally, basically out of thin air, by commercial banks every single day.
Okay, so let's get into how this actually works. Understanding this one fact really changes your entire view of the banking system. It's not about lending, it's about creating. And to get there, we first have to tear down a really common myth.
The story we're all taught is that banks are basically just middlemen. You deposit your savings, and the bank lends that same money out to someone else, right? That's the myth. The economic reality is way more powerful. Banks aren't lending out existing money. They are literally creating new digital money every single time they issue a loan.
To really wrap your head around this, you have to think about money differently. It's not so much a thing as it is a system. Modern money is really just a social technology built on a massive system of IOUs, of credits and debits. That digital number you see when you check your bank account, that's the most common form of money we use, and it's basically just the bank's IOU to you.
Okay, let's walk through a real-world example. Say you get approved for a $500,000 mortgage. The bank doesn't go into a vault and find that money. No, with a few keystrokes, it just creates a brand new digital deposit for $500,000 in your account. That's it. On their books, your loan, your promise to pay them back, is now an asset for them. And the new money they just created for you, that's a liability. It's why they sometimes call it fountain pen money. It's created with the stroke of a pen, or, the click of a mouse.
And here's the really crucial part to understand. This is a two-way street. So if making a loan creates new money, what do you think happens when you pay that loan back? That's right. The money gets destroyed. As you pay down the principal on your loan, that digital money just vanishes. It's removed from the money supply.
All right, so at this point you're probably wondering, okay, but what about the Fed, the Federal Reserve? If it's the commercial banks like Chase or Bank of America that are creating most of the money, what is the central bank's job? Are they a printer or something else?
It helps to think of it as a two-tiered monetary system. Tier 1 is central bank money. This is the heavy-duty stuff, physical cash and digital reserves that only banks use to settle payments with each other. Think of it as the wholesale layer. Then you have Tier 2, which is what they call broad money. This is the money that you and I use every day, the commercial bank deposits we've been talking about. The Fed's real job is to control that top tier in order to influence what happens in our tier.
So the Fed isn't really a printer for the public. A better way to think of them is like a conductor of an orchestra. Their main tool, their baton, is the interest rate. By raising or lowering interest rates, they're essentially setting the cost for commercial banks to create that new money. Higher rates make borrowing more expensive, so banks create less money. Lower rates do the opposite. They're not turning the faucet on and off themselves, they're telling the banks how expensive the water should be.
And this leads us to something you've probably heard a lot about, quantitative easing, or QE. And here's the uncomfortable truth about it. QE is not the government printing money and handing it out to people. It's actually an asset swap. The Fed creates those Tier 1 bank reserves we just talked about and uses them to buy things like government bonds from the big financial institutions. The whole point is to pump liquidity into the banking system, not to put money directly into your wallet.
Okay, so we've covered the mechanics, but this is where it becomes truly significant. Because this system, where money is created as debt, has profound, real-world consequences for every single one of us. And look, this isn't just some abstract economic theory. Let's look at what happened in 2020. During the pandemic, the response from the government and the central bank caused the money supply to just explode. We're looking at the M2 money supply here. That's basically all the cash in the bank deposits out there. And it surged by an absolutely unprecedented 23.6% in just 1 year. For context, it usually grows around 6%.
What this reveals is a structural dependency at the heart of our economy. Because new money is born as debt, the entire system needs a constant expansion of credit just to keep moving forward. Think about it. To pay off all the old debts in the system, plus the interest, we have to create even more new debt. It's like a treadmill. If borrowing slows down too much, the money supply actually starts to shrink, and that's often what triggers a recession.
This brings us to a really wild thought that exposes the core logic of the entire system. Every single dollar in your bank account is there because someone, somewhere, took out a loan. It's someone else's debt. So what would happen if everyone, every person, every company magically paid off all their debts tomorrow? Well, the vast majority of our money supply would simply cease to exist.
So, okay, we've gone pretty deep into the mechanics. But what does this all mean for you? For your financial mindset? For your future? How do you navigate this new reality, a world where money is fundamentally debt?
Well, first, you have to understand something called the Cantillon effect. It's an old idea, but it's more relevant than ever. It basically says that when new money is created, it doesn't spread out evenly like butter on toast. Instead, it gets injected into specific points in the economy. The people and institutions closest to the money faucet, the banks, the big corporations, the owners of financial assets, they get to use that new money first. They spend it before it has a chance to circulate and drive up prices for everyone else. By the time that money trickles down to the average person, its purchasing power has already been diluted by inflation.
This is why most people focus on things like picking the hot new stock. But the real, underlying game is about understanding the flow of credit. It's the expansion and contraction of debt, the credit cycle, that truly drives the major boom and bust cycles of our economy. So armed with this knowledge, you can start to build a totally new mental model for your finances. Instead of just chasing trends, you start watching interest rates and credit growth, because you know those are the real faucets controlling the flow of money. You start to see inflation for what it really is, a hidden tax on anyone holding cash. And this naturally shifts your focus toward owning productive assets that can hold their value over time. It's about thinking in terms of these big liquidity cycles, not just getting caught up in the day-to-day market hype.
And all of this leaves us with one final massive question, one that really underpins our entire modern economy. If our system is built on a foundation of debt, and it requires constant credit expansion just to stay alive, what happens when we reach a point where we just can't take on any more debt?